The single number that completely rewrites the Singapore dividend narrative right now is a 37% downward profit revision for Singapore Airlines. For a standard household, that margin compression is arriving exactly as your monthly utility bill prepares to jump 20%. This is no longer a distant geopolitical story. It is a direct threat to your retirement income floor. I have been watching this situation unfold for a while now. The data point that finally made me sit up was the freight insurance rates, and once you see that number, the gap between what the television tells you and what the physical market is actually pricing in becomes impossible to ignore. Let us look at exactly what is happening to the supply lines. What we are dealing with is an active crisis cascading through the maritime corridors of Southeast Asia. Every major port city in history has faced this exact existential question. What happens when a primary trade route is abruptly severed? Malacca had to answer it in the 16th century when colonial powers redrew the maps. Rotterdam asked it when containerization rewrote European logistics. Now Singapore is answering that question not as a theoretical exercise, but as a live physical reality. Let us examine the timeline of how this fracture occurred. The global headlines are focused on the diplomatic angles, but the physical disruption is undeniable. The press release narrative pushed just a day prior by diplomats projected a waterway completely open and ready for business following a regional ceasefire in Lebanon. The raw data reality tells a completely different story. The gap between those two narratives is exactly where retail capital is being trapped right now. Let us turn to the specific date that shifted the entire geopolitical equation. On the 18th of April, 2026, the Strait of Hormuz was officially reclosed by Iran. They cited a continuous naval blockade that entirely negated a brief 24-hour window of promised maritime passage. Ship tracking forensics and stark warnings from Shipping Association about uncleared mine threats within the traffic separation scheme proved that the initial opening was nothing more than a tactical mirage. This geographic choke point is no longer a distant abstraction. Let us break down how the market is misinterpreting this. And here is the part that matters most. Institutional capital rarely waits for the news to confirm what the freight insurance rates already show. The psychological gap we are witnessing right now is the space between the official diplomatic optimism on television and the physical reality of crude tankers turning around in the Gulf. Retail investors are buying the headline of a stabilized Middle East, while the smart money is quietly modeling a protracted maritime blockade. The consensus narrative assumes a temporary supply chain glitch. The physical market is pricing in a structural fracture. The headline tells you the trade route is safe. The premiums tell you the route is uninsurable. Let us bring this macro reality back to the domestic balance sheet. The macro reality of a severed maritime corridor eventually lands right here on the local balance sheet. It translates directly into the Singaporean wallet. In Bedok and Toa Payoh, households have already absorbed a 2.1% increase in SP Group electricity tariffs in April. But that is merely the preamble to a much larger structural shift. 95% of Singapore's power generation is indexed to natural gas, which trails crude oil pricing through a 2.5-month rolling average. The true cost of this blockade will show up as a much sharper tariff increase in the July to September billing window. We are projecting a domestic utility overhead surge of 15 to 20%. That is an unavoidable expense expansion of $30 to $50 per month for a standard household. Let us weigh this against your retirement accounts. Which brings us to the supplemental retirement scheme calculus, and this is where it gets uncomfortable. The very assets you rely on to pay those rising utility bills are facing their own margin compression from the exact same energy shock. When domestic inflation accelerates, the risk-free environment must be measured rigorously against the real yield of equity exposure. The CPF Special Account currently offers a 4.0% sanctuary benchmark, providing absolute capital protection. Against that risk-free floor, deploying retirement capital into fuel-exposed equities requires a substantial and secure premium. Right now, a transport stock represents a high opportunity cost for a mature investor trying to defend their purchasing power. Let us identify the most exposed names. The SGX sector exposure most vulnerable to this corridor disruption sits squarely in transport and utilities, specifically targeting blue chips like Singapore Airlines and ComfortDelGro. These are core holdings in countless local dividend portfolios, historically prized for their distribution reliability. Yet both entities are now operating in an environment where the Hormuz risk premium adds a volatile variable of $4 to $15 per barrel to crude prices. The geographic advantage of being a Southeast Asian capital node is completely neutralized when the input cost of energy spikes universally. The yield you thought was secured by domestic consumer demand is actually contingent on maritime security thousands of kilometers away. Let us look at the regional supply argument. The second order effect from this regional pivot is the illusion of the refining buffer. Retail investors see Malaysia and Indonesia securing alternate Russian energy flows and assume Singaporean operators are perfectly insulated from the global crude spike. What is entirely missing from that calculation is the physical port delay. Alternate supply lines are creating severe logistical bottlenecks at local stations, stalling throughput. The market is currently pricing in the existence of the oil. It is completely ignoring the physical friction of getting it through a congested, rerouted supply chain. Let us look at the hard data proving this pressure. When we examine the macro evidence dashboard, the pressure on margins becomes undeniable. The Brent crude monthly average projected for September 2025 sits elevated at $67.60 per barrel, squeezing transport operating margins. More directly, the SP Group energy cost currently makes up 76% of the tariff, up from 74% a year ago, serving as a direct precursor to domestic utility inflation. Meanwhile, the 6-month T-bill rate has shifted down to 1.47%, shifting the risk-free hurdle calculation. The analytical conclusion is clear. The engineered yields sustaining current distributions are highly vulnerable to the approaching energy cost cliff. Let us look at the specific number that changes the entire narrative. The most critical piece of evidence in this entire forensic audit is a staggering 37% downward revision in the financial year 2027 core net profit projections for Singapore Airlines. This is the single number that renders the historical dividend narrative completely irrelevant. A profit contraction of this magnitude, driven by the structural inability to fully offset jet fuel spikes, means the distributions you are relying on are mathematically unsustainable at their current payout ratios without compromising the fortress balance sheet. For a 55-year-old investor in Marine Parade holding these shares, this is not a temporary paper loss. It is a permanent reduction in the cash flow required to fund daily living expenses. Let us map this across the sectors. Across the local equity universe, capital preservation must take precedence over stretching for compromised yields. In aviation transport, Singapore Airlines is firmly in the pressured stance. The jet fuel spike is outpacing ticket price elasticity. For land transport, ComfortDelGro remains neutral for now as surcharges offset costs. But we must watch the interest coverage ratio closely. If it drops below 4.0 times, the stance shifts to pressured. SP Group linked utilities are heavily pressured due to the gas indexation lag, which will force pass-through shocks to the heartland consumer by July. With this framework in place, you need to interrogate your own holdings. Quick pause. You're not here for hype. You're here for forensic math before capital goes in. If this risk check helped, subscribe. It's how the algorithm knows SGX data deserves reach. Next, let's go on to the 3 questions for your portfolio. Given this forensic read, direct 3 specific questions at your own portfolio right now. For land transport operators, if temporary ride surcharges cannot be made permanent, does organic net property income still clear your required minimum yield hurdle of 4.7%? For the aviation blue chips in your portfolio, at what specific crude oil price does their current hedging strategy become mathematically insufficient to protect the dividend payout? And for discretionary equities, does the current yield truly justify the opportunity cost of leaving the absolute sanctuary of the CPF Special Account yielding 4.0%? Let us turn to how we play this structurally. My personal sanctuary threshold remains 3.2%, and a sustained macro shock does not change that floor. It merely changes how many assets can still clear it. The shock absorption capacity across the transport sector is highly uneven and strictly dependent on individual corporate hedging parameters. Singapore Airlines maintains a direct exposure buffer through a 41% fuel hedge for the current quarter, relatively robust. But the forensic reality is that this protection drops sharply to 24% by late 2026. The financial buffer runs out exactly when the macroeconomic pressure is projected to peak, and we must watch the critical domestic deadlines. ComfortDelGro is currently using a 50 to 80 cent temporary surcharge mechanism to defend its operating margins without cannibalizing the bottom line. The threshold where this buffer fails is the end of May, when these fees are slated to expire. If the national associations cannot negotiate a permanent calibration, the higher fuel costs will sever the distribution capacity. Utility-linked assets are facing a pass-through delay where the energy cost buffer will decisively run out by the July tariff adjustment window, transferring the shock directly to consumers. Let us address those still actively accumulating assets. If you are still drawing a salary and actively building your portfolio, the forensic picture suggests that extending capital into fuel-sensitive equities right now carries an uncompensated geographical risk. The temporary supply disruptions noted at local refineries indicate that regional arbitrage through Malaysia and Indonesia is not a perfect shield. Watch whether the balance sheets of these transport operators can maintain their gearing ceiling below 35% if they are forced to absorb higher fuel costs to defend their market share. And what if you are already relying on these distributions? If you are already drawing down your supplemental retirement scheme funds or living partly off distributions, your required income floor is under immediate threat from two sides. Your domestic utility expenditures are expanding visibly, while the dividend integrity of your transport holdings is actively eroding under the weight of the Hormuz risk premium. Measure your current holdings against the absolute safety of government securities. Ensure your portfolio maintains an interest coverage ratio above 4.0 times to survive the coming margin compression. This leads to the ultimate stress test. Here is the retirement floor test you need to apply today. If your monthly utility bill increases by 15% in July and Comfort Delgro's fees are forced to become permanent, does your current dividend yield from this asset genuinely cover the $120 per month gap in your retirement floor? The risk premium is expanding rapidly. The financial compensation for taking that risk is actively shrinking. Let us look at the warning signs we had. The red flags for this structural fracture were always visible if you applied a strict forensic framework before the opening bell, rather than chasing headline yields after the damage was already done. The difference between securing a safe sanctuary yield and falling into a yield trap is decided long before the market opens, not after the price violently moves. When the fundamentals disconnect from the official diplomatic narrative, institutional capital moves early, which brings me to how we track these discrepancies. If you want to stop being the exit liquidity and get zero-day access to full forensic breakdowns and red zone watchlist before the free version drops, you need the right tools. Joining Iggy's Elite Investors gives you institutional-grade cheat sheets that expose hidden debt overhangs before the market opens, all for less than the price of a Kopi and Kaya toast set at Raffles Place. Do not wait for the mainstream headlines to confirm what the data already knows. Secure your access today. The ultimate consequence of this maritime corridor disruption is not merely higher fuel costs. It is the forced repricing of distance itself. We have built portfolios on the assumption that global supply chains are frictionless and energy overheads are predictable. The data from the Gulf entirely invalidates that premise. The margin of safety for a dividend investor is no longer determined solely by local management efficiency. It is determined by naval blockades entirely outside of their control. A 60-year-old retiree in Marine Parade, heavily weighted toward domestic transport yields, is essentially underwriting the geopolitical risk of the Middle East without receiving the corresponding risk premium. Their retirement security is anchored to a waterway they will never see. The disruption of the Hormuz corridor proves that geographical moats offer no protection when input costs spike universally. As utility tariffs climb and corporate margins compress, the true cost of chasing uncompensated yield is the permanent erosion of your retirement baseline. You have to ensure your capital is anchored to balance sheets that can actually survive this repricing. I am Iggy Forensic Investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get zero-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds. 2/2